Good morning. Welcome to America First Wealth Management Investment Outlook podcast for the week of July 29th, 2024. My name is Dan Liu, Chief Investment Officer and Portfolio Manager at America First Wealth Management. And joining me is Michael Chia, our Head of Fixed Income and Portfolio Manager. And once again, we're doing our weekly investment outlook, and Mike and I do this typically Sunday evenings or early Monday morning, and it helps us prepare for what happened last week and taking a look at what happened last week and looking at what's coming up this week. So it helps us crystallize our thoughts, plan for the week, and think about intermediate and long-term strategy as well. So hopefully everyone who's tuning in finds this useful, and we'd love to hear your comments. Next page, Mike. This is our standard disclaimer. We're not offering investment advice. We're simply giving you useful information that will help you and your clients assess what's happening in the markets. And our views may change depending on information and the environment, and we'll update this on a weekly basis. Next page, Mike. So the picture of the week, as we all know, President Joe Biden withdrew himself from the presidential election rather late in the process. There was a bit of turmoil because the Democrats didn't know who their candidate was going to be. But in a late surprise last week, Joe Biden endorsed Kamala Harris, and many of the states followed suit in supporting her as well. And even former President Obama endorsed her candidacy late in the week. So exit Joe Biden, enter Kamala Harris. So the stage is set for the presidential election between Donald Trump and Kamala Harris. And it will be a very interesting one because Kamala Harris, I believe, is the first Democratic presidential candidate who didn't receive one single primary vote. So she's not been fully endorsed by the primary process, but she's endorsed by state delegates who typically vote who their populations have voted for. So it's kind of a very interesting situation here, and we'll see how it works out. I believe the two candidates are scheduled to debate each other in September, so we'll be watching that very carefully. It looks like Harris is fully endorsing Biden's policies, so it looks like much will be a continuation on an economic policy basis. And also Trump has his disparate and quite different economic goals as well. Next slide, Mike. So for the week ending July 26th, markets were rather tumultuous. You can see the NASDAQ was down sharply, down 3.86, NASDAQ 100 down 4.44, continuing this is, I believe, the second week in a row we've seen down NASDAQ and down NASDAQ 100 results. For the month and quarter to date, we're seeing negative numbers on NASDAQ and NASDAQ 100, most of which occurred last week. We did have a sharp rally on Friday, a recovery in the tech stocks, largely driven by the PCE numbers, which I'm sure Mike's going to talk about later. Also interesting was the Russell 2000 continued to rise, up 1.78% last week, and up a very strong 10.64% for the month and quarter to date. And quite interestingly, you can see the Russell 2000 is just behind the NASDAQ 100 index on a year-to-date basis. Russell 2000 is up 11.49. The NASDAQ 100 is up 11.91. So much of the small caps rally has occurred in the month of July. So as they say, regarding market timing, it's hard to time these things. You have to be in it to win it. And those who have suffered through small cap performance for most of the year were repaid very handsomely in the month of July. The Dow was up 0.43%, S&P was down 1.89. This is for the week. And values showed a slight resurgence versus growth. As you can see, Russell 1000 value versus 1000 growth. International stocks were largely flat, down 0.15%. Bonds, as measured by the iShares Core Aggregate Bond ETF, was up slightly at 0.28%. Next slide, Mike. Turning to the 10-year Treasury yield, the trajectory of the 10-year yield was bullish. It dropped 5 basis points for the week, and you can see it has crossed the 10-day moving average on a downward basis. So that's rather bullish for interest rates. And for the year to date, the 10-year yield is up 0.32%. But you can clearly see the trend is down on the 10-year yields. Next slide, Mike. A new slide we're adding this week is the yield curve, and we are showing the bottom curve is the year-end 2023 curve. In the middle is the yield curve ending Friday, and the top curve is the yield curve at the end of June. So you can see that the yield curve is still inverted, which typically suggests recession. But on the other hand, if you look at it from the roughly about the 5-year all the way up to the 30-year, we do have a upward sloping yield curve. So while it's difficult to do the carry trade on a very short-term basis, borrowing short typically under 1 year and lending longer, because the short-term rates are higher than the longer-term rates, that carry trade doesn't work. However, if one is able to borrow at the 3 to 5 year basis and lend out longer, you can achieve a slight positive spread. Whether or not it's worthwhile to do remains to be seen, because those margins are quite low. But in adequate size and possible leverage, one can make some money there. We're going to turn it over to the economy and Mike's portion focusing on the macro, and then we'll return back to me for additional comments on the stock market. Mike?
Okay, thanks, Dan. Well, growth in Q2 was surprisingly strong at 2.8%. The question then is, are we moving forward? Are we going to get enough sign of a slowdown that allowed the Fed to ease policy rate? There's some hope from the inventory side. As you can see, stale inventory posed the biggest increase in a year, and this is a share of homes sitting for 2+ months ticks up. So clearly there is some slowdown in the consumer demand for goods, and this is going to lead to an inventory drawdown in the near term, and that's going to detract away from GDP growth. Similarly, we now are starting to see buyers are not buying homes, and sellers are getting edgy, and some are cutting prices, right? Because for example, here, this chart shows share of home sitting for 2+ months have gone up. And we have shown similar chart before. I just show it again with updated numbers. And what are we seeing? This is share of credit card balances past due climb higher since 2012, right? So look at the blue color, 30+ days, right? A lot higher than actually 2012. And if you look at plus 60 days, and plus 90 days. So we are going to see some cutback by the consumer. And as Dan mentioned just now, the market reacted very well with the number that came out on Friday. And if you look at the green color, this is the US Bloomberg PCE core services less housing. This is a super core that the Fed has been talking about. You see this drop here, and people who are looking at the 3-month moving average, this white line here, you see a very sharp drop. Okay, right. However, there are people who are arguing that, hey, no, not so fast, because if you look at the 12-month moving average, you see a stabilization, right? Stabilization, right? So the Fed is looking for a sustained drop, right? So the question is, what do you see as sustained? Clearly not the month-on-month. Some would argue that the 3-month is a leading trend. Others will argue that we should look at the year-on-year numbers, the 12-month moving average. And here's another perspective to see how we align with a Fed 2% target rate. And you can see how, if we look at the PCE price index alone, you see a slight curve up. And if you look at the core, we have declined, right? And well, core services has is now more stable, like the decline is more gradual, right? And a large part of this decline comes from durable goods. So durable goods has a big drop, right? A large part due to the weakness in the Chinese economy earlier on, right? And this is rather surprising, or well, to some people, because if we look at the Shanghai containerized freight year on year, right, and you see this sharp jump here, we are as high as the COVID days, right? And this has provided very good. This blue line has been a very good predictor of the Chinese PPI. So we know that in the past, when the Chinese PPI is stronger, it tends to pass on to the US PPI and find its way into the CPI. So, well, this is an early warning indicator, and we are paying very close attention to this. Moving on to the bond market. And this is the yield curve from another perspective, aside from what Dan had shown just now. We are seeing that the 2 to 10-year yield curve have steepened, right? A lot of time when we see an inverted yield curve, we take it as a predictor of inflation, right? Which is true, right? But a more refined way of looking at the timing is when the curve start to steepen again after an inversion, right? And the important idea to think about is that when the curve inverts, banks are less willing to lend money. Okay, the lending standard tighten, and when the curve steepen, right, where you have the long end higher than the front end, okay, so start to be less invert. So when the long end rate goes up, it pushes up the corporate bond yield up. Okay, and obviously higher corporate bond yield is an additional burden on corporate America and likely to lead to a slowdown in the investment in machineries as well as inventory and so on. Right? And what is extremely troublesome but not getting enough media attention is national debt. We are now 35 trillion and rising, right? The right way to look at this 35 trillion is to divide this by the size of the GDP, right? Because how much debt the country can support depends on the size of the economy, right? And over time, obviously, a country can incur more debt because the GDP is also growing, right? So if we look at the debt to GDP ratio, we see how it spiked up to 130% during COVID. Right? Subsequently, it declined as GDP grows, right? So now, what we have is GDP is still growing, but the debt is rising faster than the growth rate in GDP. So we see this turning up again. So for people who are trying to time their investment in the bond market, this is something to watch out for, right? And here we have this rather dismay chart. This is the US government interest payment as a percentage of tax receipt, right? So actual interest payment as a percentage of actual tax receipt quarterly. We look at 35%, right? So 1/3 of the tax that is collected by Uncle Sam goes to pay the interest, and this is up from 20% not so long ago, right? So what does this mean? Well, this means that the pie is so large in terms of the tax that we collected, right? 20% goes to interest payment in the past, allowing 80% to be spent. And now 35% is paid as interest, allowing only 65% of the tax to be paid. So if the government wish to approach this as a problem, then the natural approach would be to cut spending, right? To cut spending because there's just not enough money, not enough tax collected. The alternative is to continue spending, right? On top of the rising interest rate, on top of the rising interest burden, and that means more borrowing. Okay, more borrowing, more supply of bonds. Right? There are people argue that it's okay at 35%. We had been 50% in the 80s before. Well, I hope we don't get there, right?
Mike,
Moving on, yes, go ahead.
the other thing the government can do, and from the late 80s through the 90s, is the government, well, the Fed cut interest rates. So when interest rates drop, naturally, tax receipts should go up and interest payments go down. On the other hand, you do risk inflation. So you can't get a free lunch anywhere, unfortunately.
Exactly. Well, during COVID days, when the Fed did the cut interest rate and the QE operation that brought the long end down sharply, right? For some stupid reason, Treasury Department decided to borrow more money in Treasury bill, right?
Mhm.
At close to 0.5%, right? Instead of paying up to the amazing 3%, okay, right? Had the decision been made to issue more bonds during the time and lock in interest payment at 3%, 3.5% for 30 years, the US government today would be in a much easier position to handle the problem. So this leads on to the next point, the dollar, because on a structural basis, given how the printing of money, the borrowing of money is out of control, right? It should, right, make it difficult for foreign government to remain as confident in the U.S. bond market as before, right? So, so what we are seeing on the chart, right, is that the dollar had that weakened for a time period and then broke above the downtrend line. And now we are at the resistance line here, this horizontal resistance line, right? So, my thinking is that the dollar is likely to decline on a structural basis. The question is, within the structural basis, do we have enough of this cycle for the dollar to go up, right? This is important because if the dollar were to decline, that's going to lead to imported inflation and make it harder for the Fed to consider raising rates. Energy, I like to look at this kind of chart every now and then because um, as somebody who's as someone who's very skeptical of the media over focusing on one thing and neglect other data, we have all been talking about green energy, and the fossil fuel are gone, right? But look at this. This is global oil and gas consumption per capita per annum, right? Look at the gas, look at the oil. It's not coming down. It's not coming down. So why am I looking at this? Well, because so long as energy price remain high, that's going to make it difficult for inflation to come down significantly enough, sustainably enough for the Fed to feel comfortable. Okay? Right then, over to you.
Okay, back to stocks. So as everyone who's been following knows, I like to track the Magnificent Seven, as does many market watchers. So this is the second week in a row that the Magnificent Seven was down sharply. 2 weeks ago, we saw Magnificent Seven names selling off, and last week they continued to sell off. Tesla in particular reported their earnings, which were a disappointment, and the stock sold off over 8% during the week. It's still up on the month to date, quarter to date basis, but yeah, had a tough week last week, as did the rest of the Magnificent Seven. You can see for the month and quarter to date, we only have two names that are up in the Magnificent Seven, Apple and Tesla. Year to date, we have 6 names up, only Tesla down. Do want to highlight that Microsoft is reporting this week. The big name everyone is following is NVIDIA, and they do not report earnings until the end of August, I believe, August 28th. So we'll have to wait for good news from NVIDIA at the end of August. Next slide, Mike. Wanted to show this chart, which I think is very interesting, shows the Magnificent Seven market cap as a percentage of the S&P 500. And you can see it's peaked recently at 34%. So about a third of the S&P 500 names were represented by the Magnificent Seven. For active large cap managers, that is both a blessing and a curse. The large cap active managers have to own these 7 names, or most of them, and they have to own a very large proportion. Even at an equal weight basis, you have to own 5% each of the 7 names to get to about that 34-35%. So that is a concentration risk that active managers have because of Magnificent Seven. So there will be a sigh of relief as this percentage drops, but those who are holding the Magnificent Seven bag, so to speak, are forced to hold it as it goes up or down. And especially during earnings season, there will be a significant amount of volatility, and it's going to be a stressful period for large cap active managers. Next slide, Mike. In terms of sector performance, and as Mike had noted, the stress on credit card payables being extended, and also credit card delinquency rates have also been ticking up. They're at a recent high, I've noted as well. And you can see the worst performing sector for the week and also year to date is the consumer discretionary sector. I don't see any relief in sight until there is a cut in interest rates to help the consumer out there. And, you know, that's a sector we remain overweight. And there may be some slight relief rallies for specific stocks, especially the value names like the Walmarts or Dollar General, that will probably continue to benefit. For the week, utilities were the top performer, pretty much following the continued decline in the 10-year yield, and also with the volatilities in the markets, utilities tend to be a safer sector to hang out in. Also, a safe sector to hang out in traditionally is healthcare, and healthcare was the #2 performing sector for the week. And then going down the list, materials, financials, industrials, and real estate, and consumer staples eked out a positive return. However, energy, communication services, and technology, consumer discretionary were all down. So this is typical, in my opinion, of higher volatility and flight to safety within equities. We don't show it, but there was also very high inflows into gold ETFs during the week, indicating an additional flight to safety. And also gold had hit a new record high, I believe, early in the week, but sold off during the week. And I think investors took advantage of the sell-off in gold to allocate more to gold. Next slide, Mike. Looking at the factor performance, which we like to track, the top are the qualitative factors, the bottom are the style factors. And at the top, spin-offs, buybacks, and private equity names were up during the week. The IPOs, the quality factors were down during the week. And you can see for the year, quality and spin-offs and private equity names that went public were the best performance from the year. Turning to style, as confirmed by style and consistent with the market indices, small cap and value, large value, and dividend names were up, and growth and momentum were the laggards and worst performance for the week. Next slide, Mike. Turning to commodities, we do, on the positive note, we do see that on the top, the majority of the energy commodities have been falling in price, with the exception of coal. Natural gas is down almost 23% on the month and quarter to date, down almost 10.5% for the week, and down 13.4% for the year. To me, that suggests that utilities that generate electricity, having the option to use natural gas for baseload capacity generation, will probably consider switching and use natural gas, certainly in lieu of coal, because coal has obviously been rising, natural gas has been dropping. Gasoline prices dipped a little bit. Heating oil and crude were down during the week, which should be a slight benefit to consumers and to companies that use oil as feedstock product. Turning to the metals on the bottom, gold was largely flat during the week, although it looked like it was, on an absolute dollar basis, I think we approached $2,500 in gold, and it pulled back and settled just under $2,400 for the week. The industrial metals, aluminum, copper, steel, were all down during the week. Silver, being the poor cousin of gold, was down sharply relative to the gold, suggesting that there are more speculators in silver and a break in gold tends to cause a rush to the exits by silver speculators. Next slide, Mike. And continuing on to the agricultural commodities, kind of a mixed bag. We see rice rising sharply during the week. Cocoa continued to rise. Lumber prices, although down for the year, were up a bit during the week. Beef prices, as indicated by live cattle, continue to rise. Sugar reversed its downward trend, up slightly during the week. And then running down the list, the soybeans, wheat, coffee, and corn were all down. Cotton was also down. So overall, kind of a mixed bag. There are some signs of some stabilization and some dropping in especially the food commodities. And I think that's important to note. Hopefully that'll translate into stabilized or lower food prices for the consumer. Next slide, Mike. Turning to the economic calendar, which we also like to present and show to everyone for the week of the 29th. The key numbers are always going to be highlighted in red, which is occurring on Tuesday. The JOLTS job openings number, that's going to be an important number because there has been some pressure on job creation. So we're going to be watching that one carefully. If the economy is showing signs of slowing, the JOLTS job openings number will be slightly below consensus. Consensus is 8.03 million. The forecast of 8.5. The previous JOLTS job openings number is 8.14. So we continue to show a decrease. That will obviously be bad news on the economy, which can translate into good news for interest rates as it lends some pressure on the Fed to cut rates. So that'll be an important number to follow on Tuesday. We also have some additional home price and house price index numbers that'll be important. A couple of auctions, three short-term auctions on Monday. And other than that, that's it for Monday and Tuesday. If you want to turn to the next slide, Mike. Wednesday's always the big day with a lot of news that pretty much repeats itself week over week in terms of this data. And the Fed interest rate decision on Wednesday at 2 o'clock. Don't expect any surprises here. There probably will be a non-event in terms of any interest rate decisions here. Much will be focused on the rhetoric and expectations. And Mike, if you have any thoughts about what they may be announcing on Wednesday, please chime in here.
Well, the market's expecting the press conference for Powell to give some guidance that they may cut rate in September. However, I think if the Fed were to do that, it could be a mistake. Why? Because the Fed the Fed is a political animal, and you have to respond to public pressure, right? So right now, there's no public pressure because inflation is not a problem, so there's no need to talk about raising rates, right? And the unemployment rate has not gone up significantly yet, so people are not complaining about the job situation. So I think the Fed have to be careful about the number of bullets they have, right? Because if they were to use up the bullet, and when inflation has improved, but the unemployment rate has not, unemployment is fantastic, the numbers are very low, right? So if they cut rate too soon, and then subsequently we have a flare up in unemployment rate, they have to be seen to be doing more, right? Like people don't care that they have cut rate 4, 5, 6 times, and now unemployment rate goes up. People want to see action.
Yeah.
Will the Fed then go back to QE? Is that the right move to do? So I think the Fed should be careful not to use up the bullet too soon.
Yeah. And I'm going to repeat what I commented previously regarding the political situation. We know Donald Trump has stated that he's happy to let Jerome Powell remain as Fed chairman till completion of his term in 2026, which is halfway through the next presidential term if Trump is elected president. But he also cautioned that Powell should not cut rates in September because that could artificially prop up the stock markets and influence the elections. Meanwhile, the Biden-Harris camp typically has been largely silent on any Fed rate decisions by the FOMC, so pretty much hands off there. So also given that situation, unlikely, and I agree with you that there should be any surprises or any cuts in rates on Wednesday or perhaps even in September. But I do also caution that the markets are expecting a rate cut in September. I think the Fed Fund futures have been predicting 100% rate cut in September. So possible disappointment coming in September. Next slide, Mike. Turning to Thursday, not going to run through all this, but the highlighted one in red, the ISM manufacturing PMI, will be the important number of Thursday, with a consensus of 48.8 versus rising slightly from 48.5. Next slide, Mike. And Friday, important will be the non-farm payrolls and unemployment rate. Now it's at 8:30 pre-market Friday morning. That will be a market mover. Again, bad news will be good news, and good news might be bad news with respect to interest rates. Next slide, Mike. We have a lot of earnings this week and can't possibly encapsulate them all. So similar to last week, we're just focusing on the names that are greater than 100 billion in market cap for the S&P 500. Next slide, Mike. Pre-market Monday today, we've got McDonald's, which will be an important one for consumers. McDonald's, as you know, had some difficulty previous quarter because they had raised their prices significantly, and the more recent strategy has been focusing on the value portion of their menu, and it'll be important to see if that strategy will bring back the consumer. Consensus earnings for the quarter are $3.07, down 10 cents from a year ago. Tuesday after market, got the Magnificent Seven name Microsoft, as I mentioned, looking for 294, up 25 cents. Got Merck, one of the bellwether drug companies. AMD, which is one of the names in the AI space. People will be watching AMD's numbers quite closely, looking for 68 cents, up 10 cents from a year ago. And we also have Pfizer as well, another bellwether drug company. S&P Global, Stryker, and that's, sorry about the slide, it's Arista Networks at the bottom, ANET. Arista Networks is another AI play, looking for $1.94 in earnings, up 36 cents, up 36 cents from a year ago. Next slide, Mike. Wednesday, ADP, KKR, T-Mobile. Wednesday aftermarket, another Magnificent Seven name, Meta, looking for $4.78 in earnings, up a big $1.80 from a year ago. So Meta will be an important name to watch because I believe last quarter, Meta stressed their investments in AI, but they didn't quite explain how their investments would result in significant revenue growth or profitability growth. So it's more of, we're building this. We're not sure how it's going to add a lot of value, but trust us, we think it will add a lot of value. So it'll be interesting to see what Meta says there. Qualcomm is another important chip company. So we're going to be watching Qualcomm as well. They play in both the handset, and they're also trying to develop AI chips for desktops and laptops. So it'll be very interesting to hear what they say. MasterCard, one of the big consumer credit card companies, as we know. Be very important to see what they are saying about credit card transaction activity, because it's usually a very good read on how consumers are spending and charging, and we're going to be watching that one very closely. Boeing continues to look at down earnings, minus $1.79, down 97 cents from a year ago. Boeing continues to have operational problems, and I believe they're looking to repurchase Spirit Aerospace, which they had spun out in the past, just to recover their quality control capabilities. Having spun out Spirit Aerospace in the past, they seem to have lost the quality control. Bringing it back in-house obviously would be a plus in terms of improving their quality control. It's a work in process. It'll be one that we'll be watching because the stock has been depressed, and it could be an opportunity if they show signs that they're getting their quality and manufacturing under control. Turning to Thursday pre-market, Conoco, Eaton, and Regeneron. All three are looking for slight improvement in earnings per share. Next slide, Mike. And continuing Thursday aftermarket, we have Booking Holdings, which is the largest travel booking company. This is the old Priceline.com for people who have followed this name for a while. Looking for recovery in travel and strength. That seems to be one area of consumer spending that has been very strong. Travel and vacation, in addition to cruises. So we're going to be looking for hopefully continued strength in that portion of consumer spending. Intel supporting, looking for 10 cents, down 3 cents from a year ago. Got Vertex, negative earnings. But that's I think not a company driven on earnings. I think we should have reported some EBITDA and sales estimates, but the earnings are a little convoluted. So we have to look through that. Two additional Magnificent Seven names reporting on Thursday after the close are Amazon and Apple. Those will be highly watched, and pay attention to that. Exxon, I think there's a little issue here with the slide. Sorry about that, but let me turn to my other slide here. Exxon looking for $2.01, up 7 cents. And we have Lind PLC. Berkshire Hathaway, looking for earnings per share of 6,119, probably the largest earnings per share number in the S&P, because Berkshire Hathaway does not issue any stock splits. So that's been a very high earnings per share, but it's looking for down $809.40 earnings per share versus a year ago. Friday also shows one of the large, in addition to Exxon, we've got Chevron reporting. So two bellwether names in the energy space to be watched closely as well. Next slide, Mike. I wanted to close out some of the earnings discussion with comment on calendar month seasonality. This chart shows the average total return by calendar month from 1950 to present. And it's important to note that the months of August, September, and October are seasonally a very weak period. especially in September. In August and September, there are a lot of negative performance periods for the calendar month. And I just want to highlight that for investors and financial advisors, this typically is the dangerous part of the season. And as I mentioned last week, it's probably prudent to keep some dry powder here. And I think the seasonality chart illustrates that here. And also we commented extensively on the Fed rate decision in September, and expectations are 100% for a rate cut. And if those expectations are not met, there will likely be a sell-off in September. So I do want to caution and highlight that for our listeners, and hopefully it helps add value to your investment portfolio. Next slide, Mike. And in closing, as always, we are happy to receive calls and set up meetings with our clients, prospects, and or their financial advisors. And if anyone is interested, please reach out to Cleveland Ashley. His number is listed here, as well as his contact information. And also for more information on our products and services, please visit our website at AmericaFirst.fund. And that's it for us for the week, the last week of July and moving us into August. And with that, I will close here and ask Michael if he's got any additional comments to offer.
No, as usual, we are here to help. Please let us know, right, what we can do to make your job a lot easier.
Okay, thank you. Have a great week, everyone. Enjoy the rest of July, and hopefully August is a good month for everyone as well. Take care. Bye-bye.